Walk through any major city on a Tuesday morning. The once bustling financial districts now feel hollow. Towering skyscrapers, monuments to ambition, stand half empty. While headlines scream about AI and meme stocks, a far more dangerous financial earthquake is quietly gathering beneath our feet. A silent crisis building within the very foundations of our economy, commercial real estate. Is it simply a correction, or are we witnessing the slow, inevitable collapse of a multi-trillion-dollar sector? A collapse that could send shivers through the banking system and beyond.
For decades, commercial real estate was a bedrock investment, driven by low interest rates, easy credit, and the relentless expansion of tech companies. This fueled a golden age where office towers sprouted like mushrooms, and demand for retail space seemed insatiable. Investors poured trillions into what felt like an untouchable asset class, with approximately 160 million square feet of office space under construction by late 2019. Then, in 2020, the world changed dramatically. The pandemic forced an unprecedented experiment. Everyone, everywhere, working from home. What began as a temporary measure quickly solidified into a new normal, profoundly reshaping the commercial real estate market. Now, as many companies embrace hybrid or fully remote models, those gleaming office towers stand as stark reminders of a bygone era. Vacancy rates are stubbornly climbing, reaching 20.7% in Q2 2025, and foot traffic is dwindling in once vibrant urban centers. The retail sector also faced severe impacts, with widespread revenue losses and store closures, while online shopping surged by 44% in 2020. Conversely, the demand for industrial spaces like warehouses and distribution centers surged due to this e-commerce growth. Businesses are also relocating to lower tax areas, contributing to the growth of Sunbelt states like Florida and Texas. This flight to quality means companies prioritize newer, high-quality office buildings over older ones, even as overall office demand is down by up to 20% in some cities. Adapting requires landlords to offer greater flexibility for hybrid work and enhance amenities like open-air environments and touchless technology. Repurposing existing spaces, such as converting shopping centers into multi-use facilities or offices into apartments, is becoming crucial for future viability. This isn't just about empty offices. This is about a confluence of factors creating a perfect storm. Firstly, exploding interest rates. For years, CRE thrived on cheap money, inflating property values. Now, refinancing debt at significantly higher rates means many properties are no longer cash flow positive. Owners face a stark choice: inject more capital into a struggling asset or default. An estimated $1.5 trillion in CRE loans are set to mature. Refinancing these loans can mean a 2x or 3x increase in debt service costs for properties worth 20 to 40% less. Thirdly, obsolete spaces. Many older office buildings are not designed for the modern hybrid workforce. They lack the amenities, flexible layouts, and tech infrastructure that companies now demand. These become zombie properties, too expensive to convert, too undesirable to rent, draining capital. Finally, regional banks have disproportionate exposure, making them acutely vulnerable to defaults.
When a crisis of this magnitude hits, the fallout rarely stays contained. The first domino to fall will likely be the regional banks. With a significant portion of their assets tied up in these distressed CRE loans, widespread defaults could quickly erode their capital, triggering a cascade of failures. This isn't just about shareholders. It's about the everyday businesses and individuals who bank with these institutions. The ripple effect then spreads to local economies. Empty office buildings mean fewer property taxes, straining municipal budgets. Struggling downtowns mean less business for local shops, restaurants, and services, leading to job losses and a downward spiral. And let's not forget pension funds and major investment firms, which are often huge holders of commercial real estate. Their portfolios could see significant devaluations, directly impacting the retirements of millions. This financial instability could directly impact the retirements of millions, highlighting the far-reaching consequences of a CRE crisis.
This entire scenario begs the question, are we staring down another 2008? There are certainly disturbing similarities that demand our attention. Over-leveraging was a key factor then, just as it is now. We see a recurring pattern of excessive debt. Complex financial products tied to these assets, while not subprime mortgages this time, still create opacity and amplify risk. And a concentrated risk within the banking sector is a recurring nightmare, posing significant threats to stability. However, there are also key differences that distinguish the current situation from the past. The 2008 crisis struck at the heart of the residential housing market, impacting millions of homeowners directly. This CRE crisis, while potentially devastating, is more concentrated on institutional investors, banks, and corporate landlords. It's less a sudden explosion and more of a slow-motion train wreck, painful, prolonged, and potentially just as destructive, perhaps less directly felt by the average citizen in their primary residence. That said, the interconnectedness of modern finance means no sector is truly an island.
So, how do you navigate this potential minefield? At Money Mortem, our approach is always about calculated risk and informed decision-making. Here's what the smart money does and what you should consider. First, review your bank exposure. If you have significant cash holdings, especially above FDIC limits, ensure your funds aren't concentrated in regional banks with heavy CRE loan books. Spreading deposits can mitigate risk. This isn't panic, it's prudence. Second, avoid over-leveraged REITs. While REITs can offer exposure to real estate, be discerning. Look for those with strong balance sheets, manageable debt, and properties in high-demand sectors like data centers, industrial warehouses, or residential in growing areas, rather than distressed office or retail. Third, diversification is paramount. Don't let your portfolio become overly concentrated in any one sector, especially one facing such headwinds. Ensure a broad mix of asset classes, industries, and geographies. Residential property is different from commercial, but a broad downturn could still have ripple effects. Fourth, focus on fundamental value. Whether it's a stock or an investment fund, understand the underlying assets. Are they truly productive? Do they generate sustainable cash flow? Or are they built on speculative growth and cheap debt?
The commercial real estate market is facing a perfect storm, driven by structural changes in how we work and the sharp rise in interest rates. This is not just a localized downturn. It's a potential systemic challenge to our financial stability, quietly unfolding while much of the world looks elsewhere. The mortem of many properties and institutions has begun. As always, vigilance and informed decision-making are your best defenses. What do you think? Is the CRE crisis inevitable, or can it be averted? Let us know in the comments below. And if you want more Money Mortem insights into navigating these turbulent waters, make sure to like this video and subscribe to the channel.